Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Our guest today is one of the largest, even the CIO of one of the largest equity AMCs, and that's Mahesh Patil. He's CIO of Aditya Birla Sun Life AMC. Joins us right now on the show on the first day of the new financial year, on a day when the markets have started off really well. Mahesh, great having you. Thanks so much for joining in. Good morning to you. And is this, I mean, we hit new highs today as well, amidst all the talk of higher valuations, growth concerns, so on and so forth, which have existed for the last couple of months. This market is made in a habit of climbing the walls of worries as they come in. Are you surprised by this up move, or were you always constructive?
Yeah, good morning, Niraj. And yeah, I think you're right. I think the markets, I mean, there was some amount of correction phase which was there, right, in the last couple of months. And while I think we were still positive on the market, we're still positive on the market, and we think that the market will continue to scale new highs in this calendar year. Uh, our view was more on the large cap space. On the Nifty, we didn't see Nifty correcting much because while the valuations in the broader market, you can say, is slightly ahead. But if you look at the Nifty, there the earnings growth, what we have seen in the last 2-3 years, okay, is in line with the kind of returns what you have seen. If you look at last 3 year Nifty CAGR returns and the earning, they are in line or slightly only ahead. The returns are higher. So I think the actual the large cap space is only marginally expensive. And on overall, the outlook there going forward also into this fiscal year as we go in is fairly decent, right? While the strong earnings growth, what we have seen in the last 2-3 years, that is likely to moderate down, but it will still be in the double digits or the low teens or so. And so I think given that, I think the market would continue to do well. Obviously, having run up so much last year, especially in the mid cap and small cap space, I mean, there was a need for some correction. And that's what we were getting into that phase. But I think market seems to have now kind of, again, taken some support and bounced back from those levels. Having said that, I think one would still be cautious a bit in terms of the broader breadth of the market, right? Because that is likely to slightly weaken as we move forward, because the money flow which was coming in, say in the mid cap and small cap, could probably slow down a bit, and if there is any kind of a global, I mean, global markets have also been climbing the wall of worry, you can say, right? Despite concerns about US recession, slowdown in growth, global markets are strong. But if at all we see some weakness over there, I think you will see our markets also possibly reacting to that. But by and large, I think we've remained constructive on the market still. I think we don't see any major big drawdowns in the market. A mild correction or a consolidation phase is what I think one should expect in the near term.
Mahesh, I heard you say that the flows toward the small caps, mid caps may go down a little bit. Are you seeing signs of that? Part one. And part two, would that lead to a, could that, or rather not would, but could that lead to a corrective move? Or would you reckon the small caps can, time correct, if you will, because earnings growth momentum might still continue to be strong? Because we were looking at data since March 2020. The earnings growth at the small cap end of the market has been very, very strong.
Yeah, so I think there has been only a slight slowdown in terms of the inflows into the mid and small cap. We're seeing some tilt towards now moving into the large cap and the flexi cap category. But still, I think the overall flows in the mid cap category is still fairly decent. So it's not likely you will see a major kind of drawdown or sell off in the small and mid cap space. You are right to say that this is not a scenario where we are seeing what happened in 2018, right? Where we saw the mid caps, there was a sharp correction also, and there was earnings impact also, which was there. I think this time around, it's the only difference is that as rightly said, the earnings growth is still fairly good, and we think that the mid and small cap also will continue to show reasonably good earnings growth. A lot of the sectors which are where the mid and small caps are there on the domestic side, I think should see decent growth. Even sectors which have seen some slowdown in the consumer discretionary side or the consumer side, I think that could also improve going forward. So in this scenario, I would say that these over valuation in certain pockets in the mid, and that needs to be some correction. You might see a time correction or even a mild correction over there. But I mean, someone with a longer term view, with the next, say, 3-5 year view, I think mid and small cap can still do reasonably well, and can possibly on a risk adjusted basis give similar returns. So I think it's more of a consolidation, you can say, a sideways correction or a mild correction rather than a deep correction, what one be expecting in the mid and small cap. And again, the flows there are not really turned anything negative. They're only moderated down in terms of the large flows. The skewness, what we saw last year, I think is likely to slow down.
Hmm. Mahesh, if you were not, I mean, if you know, as a mutual fund CIO, your primary objective would be to beat the benchmarks as well. And in some sense, it's very difficult to go completely astray from what weightages might be there, I presume, on the markets. And that's why my question comes in, that would you be constructive on large private banks at the current scenario, not from a weightages perspective, but purely from an earnings and evaluation perspective? Or would you want to distribute that money into other assets if the weightage issues would not hold you back?
So, I mean, if your question is about whether we are positive on the bank sector or whether it'll be overweighted, that's the what you're driving at. I would say that to some extent, I think I mean, clearly the large private banks have underperformed, right, relatively vis-a-vis the broader market, and clearly that's one space where I would say the valuations are more reasonable. Again, if you compare vis-a-vis some of their historical value, they'll be closer to that, or in some of the cases, even it's slightly lower than that. And overall outlook in this sector also is fairly steady. I mean, credit growth could slow down a bit because deposit growth is still a bit of a challenge. But overall, ROAs and the ROEs are fairly healthy. So I would say that, yeah, and some of the large private banks look interesting to us at this point in time where the risk reward looks reasonably good. And this is a time where, as I said, we don't want to chase momentum. And last year was a year where we chased momentum, high growth, or even to that extent, market rewarded risk taking. I think going forward, I think one should be slightly, as I said, cautious. We need to kind of curtail risk in the portfolio. And to that extent, I think some of the large private banks provide that opportunity where there is reasonable margin of safety and possibly steady growth. I mean, it may not be very exciting, but we don't see any kind of a concern on the asset quality, okay, which could really impair the earnings outlook. So, yeah, I think could be a kind of a contra or counter-cyclical call which can take on the private banks.
Mm-hmm. Okay. And Mahesh, I'm just extending that argument a bit, or extending that conversation about banks, since we've started on themes now, to the PSUs as well. Long argued to be untouchables. They've proven to be wealth creators since COVID numbers, right, relative to private banks as well. And now the only argument that now starts to come in that the valuations are no longer as cheap as they used to be, and they aren't. But bulls argue that even if the valuations are not as cheap as they used to be, they're still reasonably valued, particularly the larger ones in some fashion. I would love to understand, are you constructive on PSU banks at the current valuations from a, say, 1, 2, 3-year perspective?
So I think the PSU banks definitely last year have significantly outperformed the private banks. Again, as you rightly said, there was a valuation catch-up which was there. And obviously, the earnings growth also was fairly strong. I mean, they've benefited from not only NIM expansion, but also significant lower credit costs, and to some extent also recoveries, right, from their earlier write-off loans. So that led to a very strong earnings growth. I think that will definitely moderate down in this fiscal year, right, in FY25, where the whole benefit of lower credit cost is there in the base now. And so we think that now incrementally here, even the re-rating, what we've seen in the PSU banks, they are under kind of valuation which was there, that has also got corrected. So it will be now more stock specific. So I would say from here on, I mean, as I said, we still remain constructive on a few private sector in the PSU banks, which can continue to which are fairly well capitalized as the most important thing, and which can continue to exhibit reasonably good asset quality, and obviously a strong deposit franchise. So are we still not? I mean, as I said, the large underperformance or the large valuation gap between private banks and the PSU bank, I think that is behind us. Now it will be more driven by individual banks, be it private banks or PSU banks. How do they deliver on the earnings side, asset quality side, credit growth side? I think that will determine the kind of a relative outperformance over there. So I mean, to sum it up, I would say that selectively, I think one would now the macro trade in PSU banks probably is behind us. It will be more stock specific going forward.
Okay. And before we take that break, a question on the macros, Mahesh. There's a Nomura note today, there's a Citi note today, all of which talk about a likely CAD surplus, current account deficit surplus number for Q4. And while it may not extend itself into FY25, but it may still remain within a 1% number in terms of a deficit. Now, how enthused are you with such a development, considering that just 10 years ago, 11 years ago, we looked at numbers which were abysmal, so to say, from there to have come to these numbers? And what are the implications of this, Mahesh, from an investing perspective?
Yeah, so I think clearly the couple of things which have happened, right, structurally, I think, which is leading to a kind of a reasonable or a lower CAD number. See, one is, I mean, obviously, if there is a domestic slowdown, right, your growth slows down, your imports slow down, then your CAD number goes down. But that's not a healthy way of, I mean, one is not too enthused by that, right? But I think what we've seen is that the reduction in CAD is primarily driven by on the export side. On the services exports, we've seen a very strong growth. Again, it's not only the IT services. In fact, IT services have slightly slowed down, but the other services which are there, which have, like, for example, the outsourcing work, okay, which is being done in the other industries. There are a lot of GCCs which are being opened up in India, which is the global competence centers by global MNCs, trying to outsource their back-end operations from India. That has seen a very strong one. In fact, that amount will, in the next couple of years, 2-3 years, can be equal to what we've seen in the IT services. So that really provides a strong kind of support to reducing the CAD. And also, I think what we are now embarking on a journey where we are trying to reduce our dependence on imports, right, especially in the whole electronic side and consumer durable side, which has been kind of increasing steadily. Trying to really now start domestic manufacturing. Okay, it's still early days, but I think structurally, I think that would bring down the pressure on the trade deficit side. So I think these are the couple of factors, okay, which can be structurally positive for keeping the CAD under control. And also on the export side, while there has been some step up by the government trying to increase exports and the whole China plus one, but in a weak global kind of a demand scenario, I think that's not really helping at the margin. But I think over a longer term, I think even exports, net exports from India can improve if we're able to get traction in a few sectors where we're trying to displace some of the supply chains which we're importing from China. So I think that is really good from a macro standpoint, from an India perspective, which reduces the macro risk for foreign investors investing into India. And that's what we have been observing, that the volatility, right, on India in terms of the various parameters. For example, the rupee volatility, if you look at last year, okay, would be on the bottom 10 decile, right? If you look at all the currencies developed as well as emerging markets, we'll be the bottom decile. So I think these things are good from a structural macro long-term stability, and that would also probably mean that foreign investors, when they look at into India, I think they would probably look at the rupee depreciation, which normally is around 3%, in the past would probably be lower, and could also make a case for the risk premium, okay, what normally India would require, okay, I think that will come down. So that means the multiples, right, when a macro stability is there, I think the risk premiums go down. I think will mean that the India will continue to trade at a higher multiples compared to its historical average.
Mm-hmm. Okay. Well, before we get back to him, quickly get in my colleague Harsh to talk about one key brokerage note that stood out today, because it has got implications for the next set of conversation that we'll have with Mahesh Patil. Harsh, I believe it is a note from ICICI Securities on a defense-led company?
Well, yes, initiating coverage on Dynamatic Technologies. largely it's what ICICI Securities is suggesting is it's an aerospace driven kind of story. Of course, they have a very strong foothold in the tractor OEM segment. That is obviously set to continue, but outside of that, what is really going to aid the numbers is the aerospace story. So what they're suggesting is that within the aerospace market, recent order wins for flight critical aero structures for the Falcon 6X for the Dassault Aviation, Airbus 220 doors, rear fuselage, all of that is set to aid some of the numbers that the company is posting. That's one. Second is with regard to the hydraulics and metallurgy division, that also is on the cusp of a turnaround. And the third piece that they're talking about is with regard to returns. Returns are set to improve. Why? Your debt is expected to start to come off. Your fresh capex is expected to be decent between the 25 to 35 crore kind of mark. And with regard to a couple of their divisions, one is the Erla division in Germany. That one has seen a restructure. And with regard to wind farms in Tamil Nadu, that also has seen a divestiture. So on both of those fronts, those are positives on the capital side of things, and therefore your returns are set to improve. Around 18 to 19% kind of margin, 17 to 18% kind of margin profile is what they are expecting, and a 19% EBITDA CAGR is what ICICI Securities is penciling in. 45 times FY26 EPS is what they are currently valuing this one at, 37% upside. 10,000 plus is what the kind of target price that they are putting on this one.
Thanks, Harsh. Thanks for putting that into perspective. Mahesh, I want to come to you on this dichotomy wherein there's this belief that value will see buying, and we are seeing the market not necessarily shying away from giving premium multiples to businesses which are poised for strong earnings growth in the next 2-3 years in newer areas, defense, aerospace, green hydrogen, wind energy, etc., etc. How constructive are you on companies which are growing strong but are priced to perfection on FY24-25 earnings?
So I think, there has always been this kind of tussle between, say, growth and value in the last 2 years, right? We've seen the value stocks do well significantly. There was a good amount of re-rating which has happened over there. On the other side, even growth stock, which have companies which have delivered strong growth or the outlook is good, I think they also continue to do well, right? Where the traditional growth stocks, okay, which were there, like say in the retailing sector, other sectors, which we have seen, their growth has also got impacted. They slowed down. I think they have seen some amount of correction. So you're talking about the whole challenge between growth and value, right? In terms of how it's playing out. I think the market will continue to reward growth, I think, going forward. I think the big, large value trade in the market has played out. I mean, at least the re-rating, okay, in some of the value stocks. And I think going forward, as interest rates kind of have peaked out and as interest rate correction happens, I think market will start looking at growth.
Where is it that you have the highest conviction over the course of the next 12 months? Something that you has the highest weightage on your portfolio and you're very comfortable with that weightage?
Yeah, so I think at least in the medium term, I think we are positive on say, sectors like, for example, automobiles, especially the four-wheelers. While the stocks are run up, I think we see a reasonably decent volume growth and margin improvement over there. We're constructive on the private banks, where we think that the large underperformance last year, I think, provides a good margin of safety over there. Also in other sectors, like other discretionary sectors, like, for example, aviation. Then on the consumer discretionary side, where we've seen a slight slowdown last year, especially in consumer durables, I think we are getting more constructive there as we move forward. There we think that the valuation correction which has happened is a good opportunity to play from a slightly longer term perspective. We also positive in the telecom sector where we're seeing that we haven't seen any kind of a price increase, but I think post elections, okay, there is room for prices to move up, and that will continue to drive earnings growth over there. Apart from that, other sectors which have been underperformers, right, in the last year, like say, for example, chemicals, because of the slowdown and the kind of inventory which is built up in the system. I think going forward, I think as the inventory correction takes place, one can see improvement in terms of the volume numbers. And a lot of companies have set up capacities, okay, in the last couple of years, which would start to now deliver. So these are some of the sectors, okay, where we would be positive in our portfolios or overweight at this point in time. Apart from that, even the industrials and the capital goods sector, especially in the power side, is where we see good demand drivers from a slightly medium to long-term perspective. And that's the area also where we are constructive on.
Got it. Got it. Mahesh, last question, because we are at the cusp of the earnings, IT will kickstart this piece per se. Just a slight deep dive there. People are a bit confused because the numbers from Accenture, etc., don't look that great. The hope is that at some point of time, if the US economy, European economy is starting to show green shoots, then order flows will start trickling in. Are you looking at it as a glass half full or a glass half empty?
I think the IT sector has been kind of, I mean, this is a sector where even a slight change, okay, in expectations or guidance has a larger impact on the stock prices. And it's fairly well researched sector in that sense. But I would still look at this sector as a glass half full, I would say, okay, because while near term, there is some amount of challenges, but I think the bulk of the downgrade we've seen behind us in this sector. I think, and going forward from here, it is just a matter of time, probably 1 or 2 quarters, where you will see at least the growth numbers starting to look better than what it was in the last year. And we still believe that structurally, I think the spend on IT and the spend toward digital will only increase. The whole discretionary spend, which have been cut in the back of the slowdown, I think will slowly start to come up. And I think I mean, and the IT companies, especially the larger ones, right, and which are fairly well positioned and able to execute well, I think they should be able to see a recovery, at least in the second half of this fiscal year. So while the valuations there are not exactly cheap compared to the historical, that's why you might not see a higher return. But I would say this is the sector which one would want to buy in the dips if at all there is a correction, because there's a slightly weak macro on the US side.
Got it. Okay. Mahesh Patil, such a pleasure talking to you. Thank you for your time and your insights. Much appreciated.
Thank you, Niraj.
All right, that's the view from Mahesh Patil of Birla Sun Life. And with that, it's a wrap on this edition of Talking Point. Thanks so much for tuning in.